Artha. I hope I'm audible. And before we start, I'd just like to request everybody to keep their mics on mute just in case. On behalf of the Economic Society, I'd like to welcome everybody to something that is really historic in terms of how we're doing it and what we're doing here. Um, the organization is for the organization Artha is a monumental event because I think it reflects in the past year everything in terms of research, everything in terms of thought that we've done, and it's a culmination of all our talents. In a few pages. And today we're more honored than ever to have Dr. Barry Acharya amongst us, who is of course live from New York right now. So thank you so much, sir, for joining us. Just for those of you who are unaware, which is remiss, but I'd still say, Dr. Acharya is currently the CV Star Professor of Economics at New York University's Stern School of Business. He served as the Deputy Governor of the RBI from 2017 to 2019, and he's also the youngest Deputy Governor in the post-liberalization era. He's widely known and respected in academia and has done amazing work in financial stability. His primary research interest involves theoretical and empirical analysis of the systemic risk of the financial sector, its regulation, and its genesis in government induced distortions. He also works on credit risk and liquidity their interactions and agency theoretic foundations, as well as the general equilibrium consequences. So we're extremely honored to welcome you here. Amongst us, we also have our principal, Professor Simrat Kaur, and I'd like to
Yes.
invite her to officially welcome Dr. Acharya.
Um, Many thanks, Dr. Acharya, for being with the Sriram College of Commerce on this very special day. It is indeed a delight and a privilege for us that no better person other than you could have been the one to inaugurate this Artha, which is a fantastic journal published by the Economic Society. And also, when I was informed about the topic on which you will be speaking this evening, the economic consequences of deficit financing, given the time period under which we are and the kind of disruptions that have taken place in the couple of past decades, I think once the wave of privatization of 1980s went over and we came over to the 1966, 70, 97 crisis of Southeast, followed by the 2008 crisis, there has been a re-emergence of the fiscal or the government policies. And the Keynesian framework is once again at the forefront. And it is very important to understand that if fiscal policies are going to be adopted in situations where aggregate demand needs to be enhanced, obviously the theoretical analysis tells us that there are going to be implications on the income, interest, inflation, and the exchange rate. Largely speaking, we talk about these four as the macroeconomic impacts of any kind of a policy. And with the kind of the current pandemic that the country is presently in, which is not just a demand or not just the supply, but the entire demand supply doom loops, which we call, I think it's the best time for fiscal policy to take a re-emergence. And my personal view, I would love to listen to you also, but I feel that if the governments are to take the paternalistic role of taking care of its well-being of its citizens, this is the right time, especially when monetary policies are not going to work. And in this context, what would be the role of the helicopter money, the impact on depreciations? Because the moment there are fiscal deficits, there would be a lot of crowding out. But that is the typical ISLM framework, and people forget about the crowding in effect of the fiscal policy. And also, as we move towards the flexible exchange rates, how expansionary fiscal policies are expected to increase the interest rates, having implications on capital inflow and thereby the appreciation of the currency, leading to net exports going down. Uh, However, given the kind of background, sir, Dr. Acharya, that you have, and the practical implications, you've been in the midst of policy making. And therefore, I eagerly look forward to being with you throughout your session. It's going to be a learning experience for me and not just for my students. And Sriram College of Commerce is the best college. We are very proud of our students. Economic Society does wonders each year, and each year they surpass my own levels of expectation, sir. So I must thank my economic society. Dr. Bose is with us. And Dr. Bose, my compliments to you and your team for taking forward the economic society each year to a new pedestal. Thank you so much, everyone. Thank you, Professor Acharya. And once again, it's a privilege to be listening to you. Thank you so much to all my colleagues and my students. And a special thanks to Dr. Bose for making this happen.
Great. Thank you so much for this kind invitation. I had to. I got a very strong endorsement from my former colleagues at the Reserve Bank that I must do this even if it is remotely. And so I'm very happy to be doing it. Congratulations to the team and the Economic Society on the launch of this year's issue of Artha. I just want to mention at the outset that I'm still in my 1 year cooling off period from the Reserve Bank of India. So I will not be able to speak specifically on India or on the recent situation and the announced policies. I'm, of course, however, happy to cast the issues in a broader context. So I think what I'll do is I'll break up my remarks into three sets of points. And then maybe leave time for questions at the end because it'd be good to understand what it is that some of you are concerned about. If you can cast your questions more broadly rather than being India specific, I think it'll enable me to answer them more directly rather than trying to wriggle around them in some way. So let me start with my first and foremost point, which is that I think there is a distinction between safe haven currencies and those countries that do not issue hard currency, which is held as international reserves or as stores of safe assets. At a very high level, you could say this is a difference between developed countries and developing or emerging countries. At a deeper level, this is perhaps a difference between countries which have very strong institutional backing for their tax, fiscal, monetary policies, as well as the condition of their bond markets. In general, I would say the higher is the institutional development, the higher is the quality of the bond markets, the more likely are international investors to consider your currency as a safe haven currency. So, why does this matter? It matters not. It certainly matters in good times as well. The safe haven currencies enjoy what one might call as a liquidity premium in their borrowing costs, because the rest of the world wants to save in these currencies. Essentially, I would say they are borrowing even at below what one might consider as pure risk-free rates, because there's something beyond the risk-free rate that these assets provide to the holders of these securities. You can call it a convenience yield, you can call it a liquidity premium, whatever is the right phrase. But essentially, they have a privilege of sorts, given all the investments that they have made in their institutional setup and the quality of the markets. Now, in contrast, if for whatever reason, either because you are at an early stage of development or for whatever reason there is lack of credibility in the institutional and bond market setups, then the world doesn't view your markets and currency as a safe haven currency. And if anything, you have now a reverse problem, which is not only do you not enjoy a liquidity premium, you almost have the opposite, which is that what gets paid to the other countries as a liquidity premium is a illiquidity discount or a negative, an additional positive term on your cost of borrowing that you're going to have to pay. So, therefore, for non-safe haven countries, even in normal times, people have shown that there are components in the sovereign credit risk premia of these countries which cannot be attributed easily to pure risk factors. They seem related actually to institutional characteristics of these countries. So people who try to apply asset pricing methodology to sovereign bonds often have to in the end take the view that the only real variables I can explain the variation of the sovereign credit risk premia across countries in the non-safe haven country space is actually a set of institutional characteristics of this country, and these go all the way down to indices such as those that are linked to the levels of corruption in your country, the efficiency of the expenditures, and of course a whole set of other governance measures that are out there. Now, in times of a shock, it could be a global financial crisis, it could be a mild crisis such as the taper tantrum of summer 2013, or it could be what potentially looks like a much deeper shock such as the pandemic that we are in the midst of right now. Regardless of the nature of the shock, once uncertainty rises, the distinction in the cost of capital between the safe haven countries and the non-safe haven countries becomes even greater. Uh, Essentially, the cost of borrowing for the safe haven countries collapses, even as their countries are also part of the shock. So, take the global financial crisis. Clearly, the Western economies were at the epicenter of the housing crisis that caused the global financial crisis to unravel. Clearly, the pandemic right now is has spread or is spreading significantly in many of the developed industrialized countries who are treated as safe havens. And barring a few, and I'll come back to this important point, barring a few, most of them have experienced significant reductions in their cost of borrowing. So, in a way, if you are convinced that the fiscal stimulus is potentially has amplifier benefits in terms of stimulating demand at such a time, then the decision to undertake the deficits is relatively straightforward for these countries because they don't have to get into too much of a calculation of the costs of borrowing, deterioration of credit market sentiments, the collateral damage that a repricing of your credit risk may impose on your financial sector, which owns very large holdings of your bonds. They may not have to worry as much about immediate ratings downgrades and so on. Put broadly, in one way or the other, their debt sustainability calculations become easier because actually the cost of borrowing goes down in a significant manner during these times. Again, the reverse is unfortunately the case for those who are not safe haven currencies. They actually, because the risks are rising, the international investor aversion to these risks actually becomes higher. The sovereign risk premia on the heightened risk as well as the lack of institutional quality become higher. And not just that your cost of capital rises, international investors might even be pulling out funds from these economies at the time of the realization of such large shocks. Now, this makes the fiscal policy calculations far more complex for the non-safe haven countries, even if one takes into the view that there are benefits to fiscal stimulus, which is that the multipliers might be large when these risks have materialized and there is, in some sense, almost a government-imposed contraction of supply, demand, and the two playing down each other, as Professor Kaur mentioned. Nevertheless, it begs the question of to what point can you take the stimulus on? What would be the fiscal sustainability calculations that international investors might do? Might you trigger a sudden stop? And might the revision in the credit risk of your bonds trigger an immediate financial sector collateral damage through the holdings of their bonds and the like? Of course, if exchange rate goes into a tailspin, that will have its own possible ramifications in terms of imported inflation, etc. At such a time. So first and foremost, I want to just put on the table this point that there is a difference. It plays out in the data, and if I can just mention one statistic that is interesting, is that stock markets all over the world have had an immediate crash once the pandemic took hold. not necessarily once the response measures were announced, but at least until, I would say, till middle of March, till end of March, almost all stock markets were correcting. The correlation of stock returns across different countries actually increased during the initial period of the spread of the pandemic. In contrast, the co-movement in the bond markets, in the sovereign bond markets across countries, has actually declined. Okay, which is that while earlier it looked like there was a common factor that was moving the global bond markets, sometimes in international finance it gets referred to as this risk on, risk off that's happening based on perceptions of risk. But when a large shock like the pandemic hits, you find that this co-movement actually weakens because the investors are actually doing this rotation from the non-safe haven currencies towards the safe haven currencies. And it's therefore they are actually moving apart, and that reduces the correlations between these countries. So it is not just a theoretical concept; it is actually real, and you can actually see this in the data. So let me then turn to my second set of comments, which is what does this mean for immediate policy responses and the longer term policy responses for especially let's focus on the second set of countries who have somewhat limited fiscal capacity to undertake their expenditures. Um, it does first beg the question of what kind of country are we talking about. Now, some countries may not be safe haven countries, but they may not have stretched their fiscal balance sheet to the brink in normal times. What I mean by that is that their fiscal deficits or debt to GDP ratios may not be very high. Of course, this would get reflected in their credit ratings, for example, sovereign credit ratings. So, what I'm trying to say is that just because you are not a safe haven currency doesn't mean that you have no fiscal capacity to spend. You may have left through your own choices, etc., some fiscal capacities to spend. And therefore, you see that uh, those who did in the very early phase of the pandemic already announced larger fiscal stimulus for their countries have tended to be those emerging markets within the space of emerging markets whose fiscal deficit numbers, debt to GDP ratios were actually not that high to start with, or their credit ratings were not just above investment grade, but sort of, I would say, had several notches above investment grade. They had, in some sense, left themselves some policy buffers to make these expenditures. So, in some sense, for them, the fiscal math calculations again become a little easier. Of course, they are all realizing that they will still face a higher international cost of capital. Nevertheless, they may have greater capacity in perhaps raising debt domestically, because note that even domestically there is an increased uncertainty. There would be some preference for safer assets even from your pool of domestic savings that the economy has. That will also want to gear towards the government bonds rather than going into the riskiest assets which are out there. And indeed, a part of the equity market corrections would happen simply because of the heightened risk and the response to this heightened risk at that time. However, if you are very close to the rating constraints, which is that, for example, you may not want to lose an investment grade rating, or if your fiscal deficit and debt to GDP numbers are quite high to start with, then it's not clear that even your domestic capacity to spend may necessarily be that high. You would have to then ask the question at what point, I think, as Professor Kaur put it very nicely, you have to ask the question of crowding in multipliers versus crowding out multipliers becoming relevant. You could, my sense is, most people are tempted to make the case, and perhaps it is reasonable, that in the short run, the crowding in multiplier is higher than the crowding out multiplier, perhaps because demand is low and the crowding out in the counterfactual may not be much of a problem in the first place, which is that the private sector may not have too much capacity to actually generate growth through investments at the present moment. The one question, though, that has to be kept in mind is that I think crowding in versus crowding out is one trade off that has to be kept in mind. The second trade off that has to be kept in mind is whether a lack of debt sustainability creates issues in terms of collateral damage to those who have positions in the bond markets, even if there isn't a crowding out multiplier that is relevant at the present point. Because while it's true that you could have a fiscal multiplier, it could be that there is still a point beyond which the crowding in multiplier doesn't compensate you as much as the collateral damage that the concerns about your lack of debt sustainability impose on the bond prices and then those who are actually holding these bonds. So that would be sort of like a financial sector collateral damage, possibly. Now the calculations get very murky, and it's almost impossible, if I could say so, to know what the counterfactuals are. And one has to end up doing what I call sometimes as just a stress scenario or a resilience kind of analysis, which is you have to ask the question: at what point will my bond market start pricing in a risk of deteriorating debt sustainability? At what point would the collateral damage on my financial sector be large? Do they have adequate capital and liquidity buffers to bear losses on their government bond positions without triggering a second problem on top of the pandemic itself? I think the last thing anyone wants in a pandemic is to be dealing with financial instability concerns that, your savers are actually disintermediating the markets and pulling money out of banks and to put into their mattresses because they don't think banks have the capital or the liquidity to actually honor their promises. So I think one would have to do some sort of stress scenario or resilience analysis of what is the strength of your financial sector to actually withstand losses on bond market positions. And at what point do you have to worry about now a collateral damage to the financial sector and the mop-up cost that the fiscal has to undertake and or incur in order to clean up or support the financial sector starts now becoming larger than the crowding in gains that you might have from the fiscal stimulus. Okay, so that's my second point. I want to stress this, which is that in the traditional macro literature, we would approach fiscal policy more purely through a crowding in versus crowding out effect. But I think that for most countries now, we have to entertain, I think, the possibility of a collateral damage channel, which is that if debt sustainability concerns are raised internationally, then of course that would lead to a capital flight and possibly some second order effects through exchange rates, etc. from that. It could also mean collateral damage to your corporate sector, which is borrowing abroad because they may not be able to roll over their debts in international markets. And second, if the government is already dissaving the domestic savings, which is that they are already a little bit in the crowding out space, even if crowding out is not the concern, there could be renewed pressures on the domestic savings, and then debt sustainability concerns could get raised, and then your domestic market could have a significant cost. And I think this collateral channel, in my opinion, is quite important because there is this one view out there, which is, of course, important and interesting, that domestic debts can simply be inflated away. That, it's what's the big deal? You can't you just impose an inflation tax on the savers and essentially reduce the problems of your debt sustainability? And my answer to that is no, because two things. One, the inflation will get priced in the external markets, so you would have to take in the sudden stop risk and the collateral damage that may arise through your exchange rate channel there. But second, inflation tax will be priced in the markets, and to the extent that it wipes out values on bonds, if it is in an essential part of the government's machinery, such as the financial sector, which is transmitting the impulses of the fiscal or the monetary policies to the real economy, you don't want to break the intermediation channel while trying to actually do your policy in the first place. So I think I want to put this as the second theme: the importance of a healthy financial sector, keeping it healthy, and simultaneously ensuring that the policies are not pushed to a point where they actually risk a bigger collateral damage through the intermediation sector than any gains that there might be through the stimulus package itself. And third, and maybe related to this, is that contrary to what everyone seems to suggest, that first and foremost, you have to simply address the immediate problems. And of course, I'm fully on board that uh, the humanitarian hardship, for those who are below the subsistence level, for those who are affected directly by the pandemic itself, and those who have very severe job risk, either having already materialized or in terms of permanent impact on their livelihoods. Clearly, that has to be the front and foremost attention of the fiscal policy. Fiscal policy in developing countries is already constrained along the lines I mentioned. And because of these constraints, it doesn't have the luxury of being not so well targeted. I think it has to be targeted first and foremost to where the consumption drop is going to be the highest. I think in the modern macro models where there is heterogeneity across sectors, they talk about marginal elasticity, like whose income is likely to have the highest elasticity to receiving an income support. Now, if you can boost consumption the most, and typically what you find is that it is in the poor households, those who are constrained will have the biggest multipliers in their consumption when you relax the constraint, because their behavior is not just constrained through a choice, through a wealth shock, it is also constrained through a liquidity shock or a borrowing constraint. So when you increase their wealth, you get a multiplier not just through the the overall impact, but you also the sort of wealth impact. But compared to wealthier households, you also get an impact from relaxing their borrowing or liquidity constraints. And so the elasticity of the consumption response to any shock to their income is typically much greater. So of course you have to focus on that. But in contrast to what is being proposed, that you can throw all caution to the wind, uh, uh, I'm not so convinced that that's the right strategy. In my opinion, this is precisely the time when, because questions of credibility of repayments, because questions of credibility of debt being sustainable, questions of will the response when you come out with the high public indebtedness from the pandemic be one of just ballooning deficits and ballooning debts, and will the government and or the central bank respond to that with a financial repression policy, an inflation tax policy, a capital controls policy, in order to deal with the problem down the line. So deal with the problem of the morning after, so to speak. Uh, you will not face it in your immediate fiscal math, but it is going to be reflected in the debt sustainability calculations of investors, of rating agencies, of markets. And therefore, you have to factor this in. And because this calculations will be done on a forward-looking basis, not just on the immediate stimulus that you get to your GDP, but whether your choices of the debt hangover that you leave the public balance sheet with down the line, will that actually mean a period of prolonged repression, inflation, tax, possibly capital controls, etc., which in turn will reduce GDP in the long run? All those calculations will be done by the markets, and therefore, in my opinion, it is not actually a good idea to say, let's throw caution to the wind. This is not the time to worry about fiscal credibility. Again, I want to stress here that it is much easier for a safe haven country to make these kinds of statements and actually to adopt these kinds of policies. They can largely expand their fiscal capacity. And as long as there is some boost to the stimulus and they can keep the borrowing costs low, the fiscal math actually works out right, because the costs of borrowing are not greater than the returns you are getting on your investments. Uh, if you don't have that kind of space, so if you are not a safe haven currency, then as I've been saying repeatedly, the math is complicated. But the math, in my opinion, can be made to work out better. And in fact, your capacity to spend in the short run would be better if you can simultaneously, while undertaking slippage, provide credible signals that you are committed to fiscal path of consolidation down the line. Okay, so I'm at a little bit of a variance with several folks in emerging markets who are saying that now is not the time to think about what's going to happen in the morning after. In my opinion, that's not that there is something better that you can do, and you can avoid the risk of saying, I'm not going to worry about what's going to happen the morning after. If you can use this time to simultaneously put in place the fiscal reforms for consolidation, better governance of expenditures, reorientation of expenditures, rationalization of expenditures, putting in place all of these measures in the time while you are incurring the higher fiscal slippage, because on the one hand, you incur the slippage, you give the immediate boost to the economy through demand and relaxation of liquidity constraints of the most affected. But simultaneously, you keep your borrowing costs low by providing credible commitment to not letting the fiscal go out of line. And if I could just take a little bit, a few moments here before maybe taking a few questions, which is that the public debts that were taken on in a large number of countries post global financial crisis, they have not been rationalized over a decade. Many countries have had to resort to very high levels of taxation, high levels of different ways through which the crowding out channel plays out, which is that your corporations have to go and borrow abroad. They end up paying sort of something on top of a sovereign credit premium that is being charged by international investors. They have to be subject to the fluctuations of risk on risk off strategies if they become reliant on external financing, as we witnessed at the time of the taper tantrum and the oil price shock during 2018. So these costs do play out in significant ways. And therefore, a crisis when politics and economics by and large align together well may actually be good moments to put in place longer term reforms. They will give credibility to those who are worried about your fiscal expansion in the short run. Will it be net positive? Is it too much? If there is a second wave of the pandemic in the world, clearly that's a risk we have to factor in. Investors have to factor in, because I think the real risk right now is not that we are in a lockdown. That's not the risk at all. If we knew that on 1st September we can open up without any uncertainty, I think the world would not be as complicated a place as we are in right now. The real background risk we have is that we don't know when the vaccine is going to be available. When can that vaccine be delivered in large measure to most of humanity? Because that would put a capital T time frame on when we can expect this stress to end. Until we know that, we are all countries are living a bit in a fog of uncertainty about whether the second wave will spread. Even when you relax, you will have to maintain social distancing norms. And many households, I can tell you from my own experience living in New York City, which is one of the most affected places right now with the virus, even though things have improved in the last 4 weeks, is that you will not step out on your own. Individuals will not step out even when social distancing norms are relaxed, because the virus is out there, and everyone is doing their calculations of what it means to step out and benefit versus the loss of life that entails. So therefore, my sense is that a country that is constrained fiscally will expand its capacity to spend in the short run if it builds credibility of how it will bring down these levels of debt in the long run. And that lack of credibility will constrain policy space. It will constrain the kind of solutions you deliver. And let me just mention one final point there, which is it's clear that if this is really a wealth shock to many, which has brought them closer to their subsistence consumption constraints, you want to do a direct transfer. That's going to be the most effective policy in getting them to feel a much muted impact of the pandemic's impact on their livelihoods. However, if you have to resort to policies which are not direct transfers, because for fiscal accounting reasons, you don't want to put the cost directly on your balance sheet, you want to do it through a backdoor route where you channel them extra credit, etc. Then extra credit in a time of uncertainty is not necessarily something that will lead to better consumption. An indebted household the last thing it wants is to become even more indebted in such times, or a business also that you can think of. And so my sense is that if you embrace the underlying problem, which is that your fiscal capacity is low because of lack of adequate institutional credibility and commitment, and use this time to gradually start uh, preparing for and giving a clear path to investors, markets, rating agencies of how you are going to deal with the explosion of the short-term debt when you come out of it. It will actually expand your fiscal capacity to do things in the short run. So those who, in my, so I'm, as I said, I'm variance with the view that now is not the time to actually talk about what you will do down the line. In my opinion, if you talk about what you're going to do down the line, and if it's not cheap talk, which is that you do it with credible commitment, you can actually expand your capacity to do things in the short run. And I think that is what a lot of these economies who are the hardest hit, what is one of the key ingredients on the credit rating of a country? One of the key ratios is your per capita GDP. So by construction, if your credit rating is low, you are most likely a poor country. Now, therefore, you have to spend more because a lot of the consumption collapse will happen on the very poor households. You need to spend more. Now is the time to actually tell everyone, listen, this is the way I'm going to come down to a better path. So it may be having a fiscal act in the first place to contain your expenditures. Maybe it could be a debt ceiling as an institution. It could be an independent fiscal council that actually provides accounting of the fiscal in an independent manner, which actually vets the budget programs before any budget expenditures are spent. And just look at it, no, United States, which is the biggest beneficiary of being a safe haven in terms of the liquidity premium on its borrowing cost. Its government cannot pass through an expenditure without it actually going through a constitutional process. Both the House and the Senate have to approve the expenditure before they can actually go ahead with the bill. Now, that's the sort of discipline and credibility you need. There is a Congressional Budget Office that is going to separately vet and evaluate every single program that's been designed on whether it was delivered right, did the money go to the right places. So, all this is a part of the machinery of fiscal credibility that is being built with investors. And my sense is a crisis is the time to actually undertake reforms because you want to boost your credibility with the markets so that you can do more of what is needed in the short run. So let me stop there, if it's okay, and I can take a few questions from everyone.
Right. Students of economics to hear something that we talked about explained so beautifully. I'm sure it's something we're going to carry uh, with us for a long time. We're joined by people who are watching this session on YouTube live and also those here, and they've got questions. So I'll just ask Pratham to ask his question to you.
Good morning, Professor Acharya. So, my question is in terms of a stimulus response, the United States is currently considering a fourth stimulus package to revive the economy. At the same time, countries like India aren't able to do that. Maybe that is because of the larger fiscal constraints that bind them, or the problem that they face with respect to, say, identification of beneficiaries. In that regard, is it fair to compare the developed world and their response with what is happening in developing countries?
Yeah, sorry, I think I was on mute for a short while. Yes and no. Yes, in the sense that the virus doesn't discriminate between countries. The virus has affected many countries in a very similar way. So, clearly, in terms of the human hardship, so what I mean is the medical needs as well as the subsistence needs on those most affected because of either the virus or the lockdown. Uh, uh, they have to be addressed, I think, in a decisive way by all the countries. No, in the sense that clearly in what way you design your response, whether you go generous and sort of in a way use your fire extinguisher sort of all over the town, or you focus on the houses which are really burning. I think in a way that's really the choice that the constrained countries have to make. I think Emerging markets have to be much, much more targeted in their stimulus. They cannot meet the needs of every single part of the society that has had a shock. Clearly, even the largest corporations have experienced a shock to their cash flows, both in the short run and perhaps even in the long run. But they have resources, they have bank lines of credit, they can tap bond and equity markets if they want to. So clearly, their borrowing constraints are not going to bind as quickly as of those who are smaller businesses, those who are directly affected by the pandemic, and sectors where working from home is not as feasible to retain productivity as other sectors. So just take travel, hospitality, etc., compared to say education, professional services, which can all be provided from home. So I think the difference is that besides the cost of capital, because of simply a quantity constraint being greater for the emerging markets, they would have to be really ruthless in making their programs very targeted. They have to focus on the immediate problem at hand. Where is the bang for buck for economic well-being and consumption in the economy likely to be the greatest? They simply can't give in to every lobbying pressure that is out there, no matter how big or rich the industrialists of your country might be. Uh,
Right. Thank you so much, Pratham. I'd like to now invite a member of our faculty, Dr. Ashirwad Dwivedi sir, to please ask his question.
Uh, Thank you, sir, for such a detailed discussion. It is very, very relevant for the days we're living. Uh, my question is related to fiscal stimulus. So, as you said, direct transfers will be most efficient, and also that we have a lot of immediate short-run objectives that a country must fulfill. For all these things, spending is required, and once we even if we target it very well, fiscal discipline will go for a toss, and most of the countries are not doing this because of the threat of rating downgrade. Now, considering the recent performance of credit rating agencies and the overall working of their models and all, how seriously it should be taken in the present context. If we don't spend, will not be able to tackle the problem. And if we do that, we have a rating downgrade. What should be done under such a situation?
I think it's a very important question, and I must confess that there isn't sort of agreement even amongst academics and economists on this, like let alone sort of outside markets. What I'm trying to say is that if economists also cannot agree on a framework to answer this question, I can imagine that policymakers would have even a harder time. But I want to make 2 points. First is that I think ratings are just messengers. See, ultimately, ratings are based on your fundamental balance sheets of the country, its various macroprudential indicator ratios, your debt to GDP, fiscal deficit, your capacity to tax, the quality of the governance of the institutions of the country, etc. So I agree that ratings may not be perfect, but I think they are more of a messenger. They are something that is enshrined in the portfolio allocation decisions of investors, because they have to meet certain mandates with their end investors in order to discipline the asset managers from not taking risks that the end investors did not have in mind. But ultimately, the question everyone is asking through the ratings or outside of the ratings is one of debt sustainability. And that is a question that has to be entertained. I think it has to be entertained both in a direct sense, because it affects your cost of borrowing. But as I highlighted, there is this perception that, oh, we will deal with it in the morning after. And what I wanted to stress through the collateral damage channel was that no, if markets anticipate that the morning after is not going to be pleasant, your bonds will get repriced in the market today. That's going to impact the value of the government bond holdings on the financial sector balance sheets. And that could trigger concerns of financial stability. Now, if you are already with weaker financial firms in your economy, then this collateral damage channel would be far more prevalent. If your banking sector and shadow banks, etc., are much better capitalized, then they can actually withstand the shock rather well. I think what I'm trying to stress is that adherence to ratings above a certain level is not merely for purposes of saying ratings are important and we should care about them. It's because they are just a messenger, an institutionalized mechanism through a message is sent on your macro parameters. And if that doesn't look right and it leads to repricing in credit markets, it will lead to collateral damage. The second point I would stress is that most of the times markets are ahead of rating agencies. Credit spreads of countries rise before the downgrade typically actually happens. Markets don't wait on debt sustainability concerns for necessarily what the rating agencies are going to do. What the ratings do typically at the cusp of investment grade to the lower rating, the junk grade or the sub-investment grade rating, is that a set of international investors cannot invest in sub-investment grade paper. So the capital flight that is associated at the cusp is far sharper than it is if you get a downgrade within the investment grade space, and possibly for the downgrades even within the sub investment grade space. Because in a way, so it's almost like some people call it a cliff risk. By the way, this is there even for corporations. It's not even for sovereigns. Like even in the United States, triple B rated sovereigns, which are on the triple B rated companies, which are at the cusp of investment grade rating, are managing their liquidity in the most stringent manner. Because if they get downgraded, insurance companies and pension funds won't be able to hold their bonds. And this will lead to a widening of the credit spreads in the market. So there is a cliff risk because of these clientele effects. Most of the times, though, the market will respond even before a credit rating downgrade takes place, and the collateral damage on your financial sector will be there. So, in sum total, I'm saying that it is true that most likely there is an important fiscal multiplier on immediate expenditures, especially if targeted to those whose consumption is likely to be hit the most. Two, I am saying that ratings are not in themselves important as the true underlying debt sustainability concerns. But I think my main point is that it is not a question about what we do now and what happens in the morning after. Through market expectations, there could already be a collateral damage today if your debt is not considered sustainable. And along the same logic, therefore, if you can build credibility for how you will maintain debt sustainability in the morning after, you will have an easier time doing your fiscal policy today.
Thank
Right.
you.
Thank you so much, sir. The last question for the evening, because of the paucity of time, is from an external contributor of ours who's an economist at Care Ratings. Dr. Rucha wants to ask you, what do you think will India's fiscal deficit be in FY21? Is the monetization of deficit by the RBI advisable?
Yeah, so I think as I mentioned at the outset, because I'm in the cooling off period from my stint at the Reserve Bank of India, I won't be able to answer that question. I think Rucha has probably done her own calculations as a rating agency on these numbers. So, there are other macroeconomists who are sending me emails every day on these calculations. I think for the time being, we'll have to rely on those. I'm sorry, I'm not able to do more justice to the question.
Right. Thank you so much, sir. Before the official launch, I think from the editorial side of things, I'd like to, me and Padmini would both like to thank the entire team that has put together Artha, from the design team, from the writing team. It's been a long journey. And from the writing vertical of the Economic Society, we'd like to acknowledge and thank all the professors who are here today. The principal, of course, our teacher in charge, Dr. AGC Bose, sir, and all the external contributors who have also joined us here. Dr. Bose, if you'd like to say something right before we launch.
I didn't expect that I would be in a meeting like this at this time, in the midst of unprecedented circumstances in which we are currently living. I am beholden to Professor Viral Acharya for being with our students. And you have given us a feel of the fascinating as also complexity nature of the macroeconomic thinking. certainly those of us who are at the intro macro level would be now inspired to stretch ourselves to figure out your talk. As our principal, Professor Simrit Kaur, pointed out, the Artha looks very good, like the way the Shriram Economic Summit went off very well. The students have done a wonderful job. Although I would like to caution them to sort out their tendency to delay the things. And maybe they also will have to now innovate themselves how to carry on with their work through webinars, not the way we have been used to all these years. So I'm once again very grateful to Professor Barry Acharya, Professor Simrit Kaur, and the Artha team, and all the people who have been witnessing this for making this an enjoyable session. Thank you.
Thank you so much, sir. We couldn't have had the last academic year without your support. Again, before the launch, I'd just like to once again extend a vote of thanks to the entire society for their contribution, to Dr. Acharya for being so kind to be with us, for everybody who's joined us, editors from yesteryears. Thank you so much for showing support and really imbibing the spirit that the society hopes to continue in the coming years. I'd request the president to now launch the magazine for us.
On the launch of the journal. I think that was very nicely done.
Right. I think there were some issues with audio, but I can assure you that there was a lot of work done in trying to sing the beats also. But we just adapt to the times. Thank you so much, Dr. Acharya, for joining us today morning, for this wonderful session. And again, I'd like to congratulate everybody who's worked on this. Thank everybody who's come here. Thank you so much to the principal who's been such a pillar of support for the society and its endeavors. Thank you, everybody. Thank you so much.
All the best to you and your loved ones. Stay safe and good luck with the next edition of the journal. Thank you so much.